Welcome once again to Portfolio Theory, and I believe this is video number 9. Let's move on to a little bit of review on the capital asset pricing model, CAPM, capital asset pricing model. You should know this applies to all assets, not just stocks. It's comfortable to use it with stocks because stocks have prices that are recorded all day long, not even just the last trades, but bids and asks and the sizes of the bids and asks. A lot of information available. So we're comfortable using stocks when we kind of talk about this. Capital asset pricing model. It simply says that the expected return on some stock, called stock I, over the next period, say maybe a year, is equal to the risk-free rate over that period, plus the beta of stock I, times the expected value of the excess return on the market portfolio. That's CAPM. This is a return that compensates investors for the time value of money. Okay. And this is a risk premium. This is a risk premium. And the expected excess return on the market portfolio, is the current market price, I put that in quotes, of 1 unit of systematic risk. The current market price of 1 unit of systematic risk. The beta is the beta of stock I, the stock whose return we're trying to calculate. And this shows the amount of systematic risk embedded in, put that in quotes, in stock I. Okay, embedded in stock I. So that's that, and this is that. And beta times this is a risk premium. And again, here are the details, here and here are the details for the risk premium. That's CAPM. And basically says that investors can expect to be compensated for incurring systematic risk, but no other risk. What is systematic risk? Well, what is it? I have an example here. Okay, we're going to look at 3 situations. Okay, the first situation. We have a firm that manufactures and sells some product in Mexico. And we have another firm that manufactures that same product in Japan, but sells in Mexico. So here, one firm manufacture in Mex, sell Mex. The Japanese domiciled firm manufactures in Japan and sells in Mexico. Okay? Question is, which firm is riskier? Well, this firm is riskier. Why is it riskier? Because the sales will occur in denomination of pesos, and then they've got to repatriate that back to yen. And in going from peso to yen, the price of the yen in pesos, or the price of the pesos in yen, is something that's not fixed, and it's risk. So this involves exchange rate risk. Exchange rate risk. So the Japanese firm investors have to deal with exchange rate risk, while investors in the Mexican plant don't have to. So the big question is, would stockholders rationally expect to be compensated more for an investment in the Japanese firm than the Mexican firm? And the answer is a big old no. And you're left to wonder why not. Well, it's because exchange rate risk is not compensatable. It's not a systematic risk. It's not a risk, in other words, it can be avoided, and it also can be diversified away. And if you can avoid a risk or diversify it away in a well-diversified portfolio, then that risk is not systematic and you cannot expect to be compensated for incurring it. Okay, that's interesting. Well, let's look at a second type of risk. Let's consider firms that have labor unions. So we're going to call this risk labor union risk. Labor unions can strike and they can cause a firm to lose its ability to sell. If you can't sell, if you don't have anything to sell, you can't keep your revenue stream coming in once you deplete inventories. So labor union risk. And let us think through how this works. Well, you could avoid labor union risk. You could avoid it. Just don't invest in any stocks of firms that have labor unions. But then you'd pretty much be out of the transportation stocks, right? It'd be like no transportation, and that's a big part of the economy. So, gosh, we could avoid them by not investing in transportation stocks and other labor union stocks. But if we did so, then we wouldn't have a well-diversified portfolio. Yeah, that's kind of how it works. So with labor union risk, it's like you could avoid it, but if you do, you don't have a well-diversified portfolio because transportation is such a big part of our economy, and therefore it ends up there's some average amount of labor union risk, call it LUR, in a well-diversified portfolio. There's some in there. So to some extent, labor union risk is compensatable. To some extent, labor union risk is systematic. Now, what if you went and you invested only in firms that had labor unions? Well, then you would have violated this this average amount idea. You've loaded up on it, and labor union risk isn't a risk that you can seek out to juice your returns. It doesn't work that way. You can't avoid labor union risk in a well-diversified portfolio, many would argue. But you can't then also just go and buy stocks that have labor unions and therefore have a lot of labor union risk and hope that you'll get a lot of compensation for bearing all that labor union risk. It doesn't work that way. You've exceeded this average amount idea, and therefore if you just invested in transportation stocks alone, you could not expect to be fully compensated for the labor union risk you would be bearing. So there's an average amount. So labor union risk is a risk that is somewhat systematic, somewhat not. So let's look at another type of risk. Okay, a third and final example. Let's look at business cycle risk. Sorry, it's very hard to write on this glass. The pen slides, so I apologize for my writing, but I can't do any better than that. I'll try, but I don't think I can. So business cycle risk. So what's that? Well, that's the business cycle. You have level of economic activity called economic activity, and you have time, and it just kind of goes like this. Maybe it's, trending upwards, right? Who knows? But this variability around that line is business cycle risk. Guess what? Business cycle risk is a risk that is 100% systematic. 100% systematic. 100%. Fully compensatable. So, fully compensatable. And so there's an example of a risk that investors can expect to be compensated for. So now let's look back. We had exchange rate risk, which was not systematic, was unsystematic or unique. Okay, we have labor union risk that to some degree is systematic, and we have business cycle risk, which is 100% systematic because it's not avoidable and cannot be diversified away. And so now I've identified 3 risks that affect lots of stocks. There are many more risks that affect stock returns. Many, many, many more. And there are probably risks that no one's ever thought of that exist. One of the beauties of CAPM is that you don't have to worry about what those risks are, because CAPM is basically using as the dimension of risk, the quantification of risk, the beta of a stock, say the beta of Tesla, for example. And beta shows the sensitivity of Tesla's return to a change in the market's return, okay? And so all the risk factors that are affecting the market, okay, all these risk factors that are rendering some impact on the stock market, okay, are also affecting Tesla, many of them, to different degrees than to the entire market, perhaps. But what the beta shows us is the sensitivity of the return on Tesla to the return on the market portfolio, MP for market portfolio or market proxy. And therefore, if we understand the sensitivity of Tesla's return to changes in the return on the market portfolio, then that allows us to circumvent the academic exercise of wondering, well, what are all the risks that affect or that impact Tesla returns? And then even if we were able to get all of these, magically, if we could get all those, we'd still be unable to know with certainty what are the sensitivities of Tesla returns to a change in the value of a specific identified factor. So even if we knew all the factors, we still wouldn't know the sensitivities of Tesla's return to a change in the value of that factor. So these people who build these models are building what are referred to oftentimes as factor models. Okay? And so just be aware of the existence of factor models. Be aware of these 2 big questions here. This is a big deal. Even if you get all the factors, you wouldn't know the sensitivities. So a beauty of the CAPM is that it allows us to circumvent the issues involved with identifying factors and identifying the sensitivities of the stock returns to a change in the value of that specific factor. So CAPM allows us to circumvent those problems, allows us to work around those problems. And so in that regard, CAPM is highly desirable. I'm not pro or con CAPM, doesn't matter what I think about CAPM, but this is a good argument one could make for CAPM and kind of against factor models. So that's all I have for this video. Thank you for watching.